Hello, this is Dr. Eric Bricker, and thank you for watching A Healthcare Z. Today's topic is group health insurance death spiral. That's right, that's an actual term. Obviously, it's not like literally death, but it's important for everybody who works in healthcare and employee benefits and health insurance. We have to understand what the group health death spiral is because it affects us all. Whether or not we realize it, this is an important phenomenon to be aware of. Okay, so what is it? So for a group health insurance, right, the majority of Americans, like 60%, get their health insurance through their employer, and that employer, especially if they're fully insured, it's like, okay, well, they've got premiums that they have to pay out to the health insurance company. And guess what happens every year? The premiums go up. They always go up during the renewal process. And that renewal might be 6%, but a lot of times it's like 30 or 40%. And they might negotiate it back down, but sometimes it's like a 20-25% increase. So you get rising premiums. Okay, now that increased healthcare cost some of it gets passed on to the employees. And some of the employees who are healthy are like, why am I paying all this money for health insurance that I don't use? So the healthy employees leave the health insurance plan. They go find health insurance somewhere else. Now they stay at their job, but they might get it through their spouse, or they just might like opt out. Just like, I'm just not going to take the insurance and I'll just take the risk. Okay, so the healthy people leave, and then that means that the overall risk for the group worsens. If you had 100 people and 50 of those people were like totally healthy and they were fine, and then all of a sudden you had like half of those healthy people leave the plan, well, now you only have 25 healthy people and 50 not healthy people. Okay, so your ratio of like not healthy people to healthy people got worse. So the risk of your plan worsens. And guess what happens when the risk of your plan worsens? Then the health insurance company comes back and they increase the premium again. And then you have more healthy people leave. And it repeats year after year after year where the premiums keep rising and the healthy people keep leaving. Now, that's what it is in theory. Let's put some specific numbers on it. Okay, so for a fully insured group, the Kaiser Family Foundation reported in their 2024 survey that the average premiums for an individual with employer-sponsored health insurance is $9,000, and for a family, it's $25,000. Now, that $9,000 is broken up between what the employer pays and what the individual pays. So typically, an employer would pay like 80% of the premium, and then they have the employee pay 20% of the premium. Okay, so 80% of $9,000, the employer is paying $7,200 of the premium, and then 20% of $9,000, the employee is paying $1,800 of the premium. And typically people get paid every 2 weeks, so if you divide that by 26 pay periods, that means that the person's paying $69 per pay period to be on the health insurance. Okay, and on the family side, it gets much worse. Okay, so again, you've got the $9,000 for the individual, but then the $25,000 for the family. Let's just roughly estimate, then you have $16,000 for the rest of the dependents. Okay, again, for the $9,000, you're going to have the employer paying 80% or $7,200. The employee themselves is going to have to pay $1,800. But keep in mind, for many, if not most employers, they don't pay any premium for the family members, for the dependents. That's totally on the employee. So let's say that the employer is like, we are not paying for any of the premium for dependents. That means the full $16,000 is going to have to be paid by the employee. Okay, so then you add the $16,000 plus the $1,800 that the employee is paying in premium for themselves, and that gets you $17,800. You divide that by 26 pay periods, that comes out to $685. Well, shoot. Believe it or not, there's a lot of people who are completely unable and unwilling to pay $685 per pay period to cover their family. And especially, obviously, if they're healthy, if they are not, upwards over half of people on a health insurance plan, and by some estimates, it's up to 80% of people on a health insurance plan never reach their deductible. So all these people are paying $685 per pay period. And they're like, look, we don't even use our insurance. We don't even get any benefit. We go to the doctor, we go to the hospital, we go here. We still have to pay out of pocket. Our insurance isn't even paying anything. So those healthier people, they leave. And believe me, are there people that are really spending $69 per pay period for their health insurance? And they're like, you know what? this health insurance is actually not like very valuable to me. And so like, I'd rather have the $65 or the $69 than the health insurance. Are there people that are like that? Absolutely. They're called single men in their 20s, right? Because at the end of the day, like most single men in their 20s, they don't go to the doctor at all. They don't use health care at all. They don't go to the ER, like not at all. So a lot of people are like, well, shoot, this is dumb. I'd rather have the $69. And obviously, if they've got some sort of like illness, whether it be a childhood illness or a congenital illness, or they've acquired some sort of illness or whatever that's a chronic disease, like they're going to be like, I totally get my money's worth for the $69. But for all the healthy people, they leave. Okay, so just understand that this death spiral happens in the group level. And this brings me up to the next point, which is something that's called minimum participation. So for a group, the health insurance company and even the state health insurance commissioner for many states says, look, there has to be a minimum percentage of the employees who are eligible to have health insurance. In other words, like the full-time employees, right? Because you don't have to provide health insurance to the part-time employees. Like, they have to participate, because if you don't have a minimum number of the employees on the plan participating, then you know you're going to get adverse selection, because all the healthy people are like not opting for the health insurance. And it varies by state. So here in Texas where I'm located, it's 75%. But in other states like Mississippi, there's not a minimum requirement at all. Okay, so eventually the employer might get to the place where they have so many of their healthy people leave that they don't even meet their minimum participation requirement anymore, and they can't even get a quote from a health insurance company. Okay, so the second or the next point I want to make is that this happens at the individual group level, but this also happens at the market level, where instead of thinking of healthy people leaving, think of it as healthy employer groups leaving. That's right. In the fully insured market, the entire fully insured market itself is undergoing its own death spiral, where premiums are increasing for the fully insured groups, and the healthy groups themselves, the healthier groups themselves, are leaving. Well, what in the world is a healthier group? But, number one, they tend to have younger employees. And so with their broker consultant, they're like, look, we could go to being level funded. We could go to being self-insured. We could go to being self-insured with a captive. And indeed, there's been a large movement of what used to be fully insured groups, under 200, under 150, under 100, who are now becoming self-funded because they're paying such high fully insured premiums. They're like, look, our group itself is not that sick, so we can get a better deal if we leave the fully insured market completely and then become self-funded or level funded or join a captive. Okay, so again, healthy groups leave. That means that the overall risk profile of all the fully insured groups worsens. So they have to raise premiums again on the fully insured groups, which means even more groups. And then the next year, they're like, well, then I'm going to. So the entire fully insured marketplace in some states is undergoing a death spiral. I'll leave a link in the show notes to Connecticut. Connecticut literally is going through this process right now. So it's real. Okay, so what are some solutions? Okay, so a solution is to just throw more money at the problem, right? Because the whole reason that the healthy people are leaving is because the premiums are rising too much. And so here it's okay, well, maybe the employer, instead of paying 80%, they would have to pay 90%. Or in the case of a state, maybe the state needs to subsidize the premiums for the fully insured groups. Okay, so the point is to decrease the premiums to get the healthy people back. Okay, then next up, just cost containment, right? Of course, you hear me beat on the drum a gazillion times about the use of primary care. So there's gobs of strategies and there's gobs of employers that have effectively reduced disease burden, reduced claims costs, and reduced premiums on their plans. There are smart, effective ways of doing things like primary care and direct contracting and in-network steerage to do that. So if you implement those strategies, then the overall cost of the plan and the premiums go down, so you get the healthy people back. Okay, and then interestingly, some groups do somewhat radical changes to their plan design where they actually dramatically increase the out-of-pocket max and then they decrease the deductible. So they might make the out-of-pocket max $10 $10,000 or $20,000. And the deductible, instead of making it $4,000, they decrease it to $2,000 or $1,000 or even $500. And why do they do that? Because people who have a lot of healthcare expenses, they know that they're probably going to hit their out-of-pocket max for the year. And so if the out-of-pocket max goes up for that plan, that makes that plan for that employer less desirable. So essentially that employer is making their plan so undesirable that the people who have a lot of chronic disease and are sick, they self-select and they leave the plan. They either go on their spouse's coverage or they literally find a different job that has different health insurance to better cover their needs. So like from a social standpoint, like that's not necessarily a great thing to do, but from an individual employer standpoint, you can totally change the risk on your plan by increasing your out-of-pocket max. And then they actually decrease the deductible. Again, they take it from $4,000 to $2,000 or $1,000 or $500 because again, you want to get more healthy people back. So you can get more healthy people back if you actually lower the deductible because they're like, oh, I'm healthy, but my insurance is actually going to kick in at a lower dollar amount. Again, not necessarily good for society, but like, again, I'm not here to make value judgments. I'm here to explain a phenomenon that's going on that you may or may not have been aware of before. Okay, so overall, this brings me back to an issue I have previously talked about on A Healthcare Z, and that is the phenomenon of the tragedy of the commons. Essentially, where you had the central green or the commons in like colonial New England, and all the colonists let their livestock graze on the green. And of course, if you let all the sheep graze on the green, eventually the green is gone for everybody. And so here we have a tragedy of the commons where the doctors and the hospitals and the pharmaceutical companies and the PBMs and the health insurance companies, everybody is crying poor as sheep, saying they need to eat more grass on the commons. And the commons is the money that is provided by the employers and the state and federal governments and the employees and their family members themselves. And so at the end of the day, like there are radical solutions to this. Again, like Maryland has price controls, okay? It's the only state in America that has price controls. Like, believe me, I bet you other states will look at Maryland and be like, Maryland's got price controls. Maybe we should have price controls too. So just know the tragedy of the commons cannot go on forever. Eventually the grass will get fully eaten. What will happen? When will that happen? I don't know. But it's important for all of us to understand the group health insurance death spiral. And that's my point for today. Thank you for watching A Healthcare Z.